I'm just going to talk about some of the things that happened last year that will affect your taxes for this year and going forward. I've titled it More Certainty, New Tax Breaks and Increased Complexity. So for us tax preparers, it's a little bit of job security, and I'll tell you exactly why that is in just a moment. I've got to do two toggles here to see that everything works. We'll look at the OB3A Act that went through, look at the changes that came about because of that. There are a couple of new tax breaks. You heard that during the campaign last year, no tax on tips and all that kind of stuff, so we'll talk about that. There's an extension of the Secure 2.0, which I think was in 2024, but that's starting to have an effect this year, so we'll touch on that. And then I've got a couple of other things that right at the end that we can talk about. But if there's anything you want to ask on the way through or some issues that you've seen that you want to bring up, let's talk about it. So the first thing is more certainty. The Tax Cuts and Jobs Act was the first big change we've had in tax code for several years, and that was in 2018. And that introduced 7 tax brackets, reduced the brackets down to 7. That has now been, so a lot of the things in the Tax Cuts and Jobs Act were set to expire last year. So that was creating a lot of uncertainty, and that's what this OB3A managed to put a cap on that and say, right, 7 tax brackets is going to stay. Bottom tax bracket is 10%, kicks in at about certainly 24,000, I think, for married filing joint, and the top level about 670,000, I think. I could stand to be corrected there, but so if you're above 670,000 in income, married filing joint, you're paying 37% tax, plus you're paying 20% capital gains tax. Those higher earners are getting hit quite hard. Down the bottom level, you're paying 10-12% tax at the bottom level. Standard deduction has increased. It does every year. So you may remember Tax Cuts and Jobs Act. Prior to that, you had a standard deduction and you had an exemption. So if you had a big family, you got big deductions because you got an amount for every dependent in the household. That was done away with. In fact, North Carolina preceded that a couple of years before that came out. Got rid of that exemption thing and increased the standard deduction. The Tax Cuts and Jobs Act did that, so that's now permanent as well. The standard deduction for married filing joint, I think it's 34,000. Have I got it here? 31,000 if you're less than 60 years of age. So that means you can earn 31,000 plus about 24,000. So let's say, what's that? About 55,000. And you're paying 10% tax. Because your first 31,000 obviously tax-free, you get the deduction for that. And anything up to 55 would then be taxed at 10%. So it gives you an idea of the sort of numbers that we're talking about. There's a new senior deduction that came in with the OB3A. That was the no tax on Social Security. The way they've done it, and you'll see the same with the others, is they don't not tax Social Security, they just give a deduction for your Social Security. So if you are single, you get a deduction of $6,000, and this is over age 65. Am I right? 65, I think it is, yeah. Over age 65, you get a $6,000 deduction if you're single, and you get a $12,000 deduction if you're married filing joint. Interesting thing I've discovered just the other day is you get that $12,000 whether or not both spouses are claiming Social Security benefits. So I had a situation where husband was on Social Security, wife was not. They still got the $12,000 deduction. So they scored quite nicely on that. And remember, Social Security is not totally taxable. So it works on a formula. The formula is roughly 50% of your Social Security plus your other income. If that exceeds certain thresholds, then you are taxed. A certain amount of your Social Security is taxed. So I think the first threshold is 50,000. So if those two numbers exceed 50, then 50% of your Social Security is taxed. If they exceed another number, it's 85. 85% is the most of your Social Security that can be taxed federally. Most states don't tax it. North Carolina and South Carolina don't tax Social Security at all.
And is that changing this year?
That was for 25.
In 2026, Social Security is not being taxed, or it still is?
Social Security, the deduction continues into 2026, yes, and continues permanently. I mean, there's no limit on it. There's no sunrise or timeline on it. So you will get, in 2026, you'll still get the $6,000 or $12,000 deduction for Social Security if you're over age 65. And then the child tax credit went up to $2,200. Now remember, the child tax credit is for children under 17, so 16 and 364 days. So as soon as they turn 17, that credit drops to $500, and you can claim a child tax credit up to the age of 18 or up to the age of 24 if your child is a full-time college. Okay, the no tax on tips. Again, not that tips are not taxed, it's just that you get a deduction for your tips. So it's a $25,000 deduction. So if you report your tips just like you normally do, and then you claim the deduction up to $25,000. Notice though, there's an income limit of $150,000. So this is the complexity I was telling you about. You think that the politicians would pick one limit, but no. There's $150,000 is the income limit for this. If you're contributing to an IRA, I think the income limit's $180,000. If you're doing American Opportunity Tax credits for schooling, education credits, it's a different level. Child tax credits is $400,000. I mean, it's just all over the place. So watch your income levels. A lot of the time our clients, that's where they get tripped up. They think, I've got all these credits due to me and I've got all these deductions that are available, but I had a really good year last year, and suddenly they don't get in the credits. And they end up owing tax, and they say, but why do I owe more than I would have if my income was just higher? Well, it's because you lost a lot of the deductions that you were usually used to getting.
It doesn't pay to work.
Yeah, it becomes a double whammy. And Social Security's like that too, because someone will go and they'll be earning their Social Security and hardly any of it is taxed, and then they'll take a big IRA deduction, distribution, and suddenly they've had tax withheld on their IRA distribution, so they think, I'm golden, I'm going to be getting a little refund, whatever. And we come along and say, no, your Social Security is now taxed. 85% of your Social Security is taxed because the amount of income you got from your IRA has pushed you up into a higher, it's not even a bracket, it just means that income becomes taxable. And suddenly you end up owing tax on Social Security, which you never had any withholdings on. And it's the same with these credits. So the tips is $25,000. Tips is no problem from a reporting point of view because they're on the W-2s. We've kind of got used to that. There's a special box, which one is it? Not box 5. Anyway, there's a box there for tips that's separate from your wages, but it's reported. Overtime, not so much. So again, overtime you get the deduction of $12,500 or $25,000 if you're married filing joint, but there's no place on the W-2 to report overtime. Overtime has to be time and a half. It's not, you're getting the same rate, but you've worked extra hours. You've got to be earning time and a half, which means you've got to be above how much income to, what's the limit for time and a half?
So to be if you're a non-exempt employee, you have to get time and a half if it's the 41st hour in the week.
If it's, but isn't there a salary, there's a limit, salary limit?
So the salary threshold is for exempt employees, and that's $684 a week.
Okay. Right. So, yeah, you've got to be earning that time and a half to get this credit. That's what I'm saying. So if you just...
there's no line item on the form to put with that.
They do put it on the W-2. I had a client that we printed W-2s for, and there was a comment.
Yeah.
It just print, like not like around box 14, it just put a comment in on what the overtime dollars were.
Yeah, I mean, that's what they're trying to do. But there's nothing formal. So a lot of the advice we've been giving our clients is just keep that final pay slip of the year, because usually your pay slip has year-to-date figures on it. So just keep that last payslip, paycheck, pay stub, and that should give you your overtime. But if it's on the W-2, that's great. Someone's done that. Again, there's an income limit for that, same as the tips. So that's, at least that's the same. Car loan interest is, sorry.
Question about income. If somebody is a W-2 wage earner and a K-1, in the past, one of the newer updates over the last couple of years was if you're W-2, you can't itemize deductions for business expenses. If you get a W-2 and a K-1, will the K-1 allow you to?
No.
No?
No, so what you're talking about is Schedule A, which is the itemized deductions. So pre-Tax Cuts and Jobs Act, itemized deductions is your medical expenses in excess of 7.5% of adjusted gross income, your state and local taxes, which we'll talk about in a minute, your mortgage interest and your charitable deductions. And prior to Tax Cuts and Jobs Act, there was a fifth category called unreimbursed employee expenses. And that was, and you could give anything in excess of 2% of adjusted gross income. And that would be traveling, miles. I had people claiming laundry expenses and uniforms and all sorts of things in that bottom box. Tax prep fees used to be there. I still get clients saying, well, this is what I paid you last year, make sure you claim it. Not in the box anymore, So no, that was done away with. That there are some exceptions. I think there's a military exception for itemized deductions for unreimbursed expenses, but it's all part of that itemized deductions on schedule. And that has to be compared with your standard deduction of $31,000. So that's what's happening now, is that the state and local taxes were limited to 10 grand. So you've got 31,000 you're allowed to claim. So 10 is state and local taxes, that leaves you with 21,000. Say your mortgage interest is, say you've got a big mortgage and you've got 10 grand's worth of interest expense. You've still got 11 grand you've got to find in charitable medical expense, and even if they were unreimbursed. So most people don't claim it. Most people just do the standard deduction now. If you're single, better chance that you'll be, if you're single and you've got a mortgage, you may well itemize. But most of my married clients don't itemize anymore.
Yeah, those unreimbursed job expenses, over-the-road truckers per diem per day, that was wiped out. They lost thousands of dollars in tax refund.
Yeah, and a lot of sales reps as well. Road warriors claim it all. So I was telling them that either they've got to talk to their employer about an accountable plan, get the employer to reimburse them for their mileage, or put them on 1099, which I know is not great for you, but I mean, how else do you claim those expenses? Those are real expenses. And you can't just do 1099 if they are, you know the whole story with, the 1099 versus W-2 issue is not a tax issue, it's a legal issue, it's an HR issue.
So it used to be that an employer, well, it still is, an employer chooses not to reimburse for mileage, right? So that's a perk that an employer chooses to give.
Yeah.
But historically, you could say to your employee in that scenario, like, we don't reimburse for mileage, but you're welcome to put it on your taxes.
Yeah.
So you're saying that's gone now?
That's gone.
Okay.
It's gone.
Yeah, been gone? Okay. Yeah, I was gonna say, I don't think I've had that question in a million years, but that's kind of what I remember the question being and what the answer was, so.
Yeah, no, it's gone for several years.
2019, right?
2018,
So if your employer doesn't reimburse your mileage.
That's what I'm saying. Tax Cuts and Jobs Act did away with all those.
Right, you can't take that as a deduction anymore, as an employee.
So what you could do if you were, it becomes a problem though. If say your salary's 10 grand, whatever the period is, and you usually spend 2 grand a year in deductible mileage costs, could you now go to your employee and say, well, I'm going to drop your salary to 8 and you file a claim for your mileage? So you're still getting your 10, but you can now deduct the 2 of it for tax purposes. It looks a bit schemish, eh? Because I mean, you were earning 10, and the only reason you made the change is because of the tax code. It's not really a substantive
Right,
change.
women here for having your own business and deducting mileage, you just reimburse yourself?
Like this one's gonna see, if you're an LLC or if you're an S corp, you can have the S corp pay, reimburse you as an employee, all that mileage and healthcare expenses, office expenses.
Right.
travel.
Right, okay.
Yeah, I just asked Greg.
No, that's right. I mean, you can have your own S corp have an accountable plan.
Yeah.
So you submit your expenses, you refund yourself, and I strongly recommend you actually do a proper reimbursement. A lot of clients of ours just say, "Oh, business paid this and this and this," and then we've got to sit there and uncommingle this whole mess. But it's
Do you have to do it in the 2025 calendar year, or do you do it in
Yeah.
2027?
cash basis, probably. But I would strongly recommend that you actually, say to yourself, these are the expenses I had.
Right.
Itemize them, write yourself a check for that amount, put it through the books. And then you can clearly show, company paid me.
Right.
If I get audited, there's a paper trail, there's a money trail. It just keeps it clean.
Yeah.
It's not to say it will be disallowed, but
Now that you're saying that, I did do that last year. I just forget, because I don't do this on a daily basis, but yeah.
yeah, sure. No, it can mount up, and certainly if that's one of the advantages of having your own business.
Yeah.
I remember reading Robert Kiyosaki, Rich Dad, Poor Dad, and he said he pitied the IRS, because how do you prove a business owner is not living their own business 24 hours a day? I mean, if they go to lunch or dinner with someone and they meet someone and chat to them, that's a potential client. We've got a client, Sydney's got a client who went down to the coast over December or something and spent, I don't know, 9 of the 12 days they were there scouting around for real estate, because he's a real estate broker.
Yeah.
So he claims the trip there, the trip back, and 9 days of accommodation. It's legit. It's allowed. And I defy the IRS to say you weren't doing any business. As long as he can prove that he was actually doing business.
Yeah, if you keep a log, or if you talk to, and business cards being handed out.
Yeah.
Yeah, that's right.
So
Yeah,
go back to
mine
the
was
overtime.
Yeah.
If it's not on your W-2, do we have to reprint the W-2 with it?
No, you don't have to do anything. That's why I say there's no formal thing. Just keep that last pay stub, and then on your tax return you report the portion that was
From the pay stub?
from the pay stub. Yeah. There's no,
Employees,
Well, half of the hour and a half. Yeah.
well, then
Yeah,
your employees might appreciate it, so they can go to their tax preparer and say, hey, guys, $13,000
Well,
worth of.
that's pretty, I got someone asking me, that was pretty annoying, that we were on this topic, and he hit me up on the phone asking me about, I need the W-2 corrected.
yeah, there's no formal reporting. I mean, it'd be great if, like Todd says, if someone's done it.
So put it on there, just to have it, because they know you need it.
Yeah. But IRS recommendation at the moment, because this was like last minute stuff, is just produce your final pay stub. Next year, I'm sure they'll have a.
Submit that with the form.
You don't submit it.
It's just good in the file.
Yeah. They need to keep a copy of it in case they're audited. But yeah. It just-
Most people can just download their last pay stub off the payroll system
Yeah.
and see it.
So essentially, the responsibility falls on the employee, not the
That's
Yeah,
right.
and then they have to do math, because the
Yeah,
number on the
that's-
pay stub is 1.5 times, and they have to sit there and divide by 40.
Yeah, I love it when these people get upset because they haven't got their 1099. I'm thinking, well, can't you add up how much income you had last year? I mean, 1099 just tells the IRS so that you don't lie to him. So car loan interest, that's a new one. 10 grand you're allowed to deduct on a car loan, but there are specific rules about what vehicles you can use. Not leases, for example. So just check on the requirements. But yeah, you can claim a 10 grand deduction on interest on a car loan. So that's quite nice.
Craig, are there any weight limit on the car?
No, not that I'm aware of. No, I think it has to be a US, it has to be a domestic vehicle. A lot of the legislation refers to assembled in or made in or some sort of origination within the US. So So that might be there. But just check on those rules.
Out of curiosity, where is that car loan interest deduction, where is it? Is it on Schedule A or is it right on the 1040?
No, it's on the 1040. Yeah, it's not a Schedule A.
Nice.
Yeah,
I need to buy a new car.
that's what they were hoping.
So if you have a car loan, it doesn't, you have to buy the car.
2025 new
Yes.
car purchase in 2025.
Thank you.
So does that have to be a 25 model or 26 model year?
I don't think that matters, it's
It
just
has-
the purchase.
It has to be new,
Yeah.
so I guess
It
that
could
would
be
apply.
an older inventory that's sitting around for a while.
Yeah.
Okay.
Salt caps, this is quite an interesting one. So salt is state and local taxes. And that became quite controversial back in 2018 because the expensive states, California, New York in particular, with their high state taxes, they felt they were being penalized because there was a limitation on the deduction of state and local taxes, limited to $10,000. And it's a meaningful number. It made a big difference to the whole standard deduction versus itemized deduction that we just talked about now. But there's been a lot of pressure to change that. And so now, to try and get this bill through, 40,000 was the new limit that was allowed, but it's only allowed for the next 2 years, and then it phases out by 2029 or I think 2030, it's gone entirely. So what was done after that sort, that 10 grand limit came in, a lot of the states came out with what they call pass-through entity tax. So if you have your own business, what they would do is they'd say, okay, well, if I can't deduct the taxes on my personal tax return, I'm going to allow my company to pay my state taxes and claim that deduction on my K1 from my company. And so North Carolina has it and South Carolina has that deduction. And that's called the PTE deduction. Basically, the company now pays. If you have an S Corp, the company pays the state tax and it claims a deduction on the federal return for that state tax, which means your K1 income is reduced. So you're effectively getting the tax deduction for that state tax. So now you've got to say to yourself, all right, now my PTE, at least my salt limit's gone up to 40,000. Do I still want to do the PTE deduction and have the company pay the state tax? And I would say that given that this is a temporary reprieve, it's going away, you've probably got used to doing the PTE, having the company pay the state tax. Frankly, I think it makes a lot more sense. If your company is paying your state tax, it's just one less bill that you personally have to worry about. But each to their own, I guess. But I think you should just keep doing the PTE right the way through. You're still going to get the deduction. And usually people's state and local tax includes your withholding, your state withholding on your W-2. So that usually ends up being quite a big number. But that's state and local taxes. Then we get on to some of the retirement issues. This is the Secure 2.0 that I mentioned. So remember there were a bunch of changes that came in to the retirement industry back in 24. Secure 1.0 and then Secure 2.0. And the big thing I think came out of that was the 10-year withdrawal from IRAs, inherited IRAs. Used to be able to stretch them. So if you got somebody passed and you inherited an IRA, you could take distributions over your lifetime. That was changed to 10 years max. And then regulations came out in 24 and 25 from the IRS that said, if the person who passed had already started paying their RMDs, required minimum distributions, then the person who inherited the IRA had to pay at least the RMD that the deceased was paying. But they still have to do it within 10 years. They still have to deplete that inherited IRA within 10 years.
Has that become an issue with your clients that have inherited large amounts?
It's always an issue because it's that you don't. The whole idea of 401ks and IRAs is that you're contributing a tax deductible contribution now at a high tax rate, with the hope that you'll have a low tax rate in retirement. Now you get these huge big distributions because of RMDs, your tax rate's not so low in retirement. So it ends up becoming a bit of a wash.
And it drives up your income, right? And if you're on the marketplace, that affects your marketplace.
Oh, you're talking about health insurance and Medicare, yeah?
Yeah. So it
Yeah.
handcuffs you.
Yeah. No, it's definitely an issue. The quantum that people have in qualified plans is an issue. So one of the things you probably look at is a strategy to roll over IRAs into Roths. I've done a bit of math on it. I'm not a huge fan, but it's very limited situations where you'll have it. Now we have one client. She doesn't work. She did work. She made some good money, got divorced, got a nice payout. She's got several million in her IRA. And so she's not going to work until she's claiming for Social Security. So we did the math on it and actually paid her to start taking IRA distributions now, put the money into a Roth, which is obviously tax-free when you get it out. So she can keep a tax rate low, right the way through, instead of having zero tax right now, and much higher later in retirement. So what Secure 2.0 came out with and is going to be applicable now is between the ages of, I think, 60 and 63, you can make an additional catch-up contribution to your 401k or IRA of $11,250. The other thing that people don't know about, though, is that that's limited by your income again. So if your income's over 145,000, is that 145? Then that contribution has to be made to a Roth. So politicians have been clever here, and they've said, all right, we're going to allow you to make this extra taxable contribution to your retirement planning. You can tax deduct it if you're earning less than 145, but you're not going to get a tax deduction over age 145. So it's not going to save you tax if you're earning a decent income. The $7,500 energy credit has gone from September last year. So if you're planning on buying a Mustang or a Tesla, then too late. But you can still get energy credits for your home. So if you're replacing windows or stuff like that, you can still get those deductions. Businesses. This is kind of what we deal with most of the time. Big hallelujah, from January the 19th onwards, you can claim 100% bonus depreciation again. So that basically means that any equipment that you purchase, you can claim 100% of the deduction in year one. It had dropped down to 40% from 2018. So 2018, 19, and 20, I think it was 100%. Then it dropped down to 80, 60, and 40. So you, up to January 19th, you could claim 40% of the cost of any equipment purchased for your business. As a tax deduction, after the January 19th, you can claim 100%. The interesting thing, this is like nerdy inside baseball stuff, but for us bean counters, we enjoy it. This piece of legislation says purchased, when the asset was purchased. Now, the normal depreciation deduction is put into use. So we have clients who on the 31st of December will phone and say, hey, how much equipment do I need to buy to save tax? And he'll suddenly go out and place an order on his local dental supplier for a new x-ray machine or something. And you know as sure as anything that only got delivered in January. And technically he's not allowed the deduction. But I guess it's difficult to prove that. But technically you're not supposed to claim it until it's put into use. This legislation now for January 19th, the 100%, is when it was when it was purchased. So you could have a situation where a client goes and buys something on January the 10th, gets delivered on January the 25th of 2025. They don't get the deduction. They get the 40% because it was bought before January 19th. So that's our little thing to look for, is what date did you actually purchase it, not put it into use. And most people use purchase date. But that's a really nice deduction that you still get the 179. So you know there's a section 179 deduction, which is 100% depreciation in year one. But that's limited by the amount, total amount of purchases for the year. I think it was 1.9 million in 2025, or 1.2 million. But yeah, there's a number. And 179 you cannot claim if you have a loss. But if you use bonus depreciation, there's no upper limit. So I mean, you could buy $10 million worth of equipment if your business is big enough, and you could claim 100% deduction on all of it, as long as it was purchased post January 19th. Crypto reporting, the new form 1099-DA, so digital assets. Make sure that you, and this has been around for a couple of years, there's a checkbox. Did you buy, sell, or exchange any cryptocurrency during the year? IRS is big on this because the opportunity for evasion is there. So they've now introduced a 1099-DA form, which all the cryptocurrency providers are supposed to provide you with. They do not include basis. So you still have to figure out what the cost of your crypto was, which is not that easy, because there's all these different types of forks and different types of trades that happen in the crypto world. So working out the cost of your investment is not that easy, and it's not going to be on the forms. So you've still got to keep track of that. And as I always said, make sure you report all your income. I don't care whether it's on a 1099 or not, just make sure you report your income, because that is criminal. If you don't report income, the IRS can send you to jail for that. If it's an expense that you've claimed that was more than it should have been, usually a slap on the wrist and you pay some penalties. But if you don't report income, that's big trouble. R&D expenditure, so that's research and development. We were supposed to categorize research and development expenditure since 2018 and capitalize it. That means you're not allowed to deduct it immediately. You've got to create an asset, and then you can write it off over a period of time. That's been done away with. You can now write off research and development. That usually means salaries for lab technicians and people like that. We don't typically deal with much of that, because we deal with smaller businesses, but if the bigger companies that have research departments, they would be looking at this. And then opportunity zones, I don't know if this is so much business as personal, but you may remember opportunity zones was the idea that came up if you have a capital gain. Because if you have a capital gain on real estate, you sell a piece of property, you make a capital gain, you can do a like-for-like exchange. It's called a 1031 exchange. You can go buy some more real estate and swap it out. You can't do that with stocks, for example. If you make a whole bunch of capital gains on stocks and shares, you can't just go and roll them over into another purchase stocks and shares. But what you can do is you can invest that money in an opportunity zone, which is a designated area that has been earmarked for development. And an opportunity zone fund is set up in that area, and you invest in that fund. You can defer and even avoid some of the taxes on those gains. Well, that opportunity zone was phasing out. It's been reenacted and is going forward. And they've in fact introduced now a rural opportunity zone. So there's an agricultural component to it as well. So you can now invest in agricultural areas and get a deferment of your capital gains by using that opportunity zone. And then the last thing I just wanted to touch on, which is just an interesting thing, but we were talking about bonus depreciation earlier. One of the new things that's been added to bonus depreciation is qualified production property. So basically manufacturing warehouses. You can buy a building and write off the full cost of the building, which is huge. I mean, you're talking about big investments here, big numbers. Very strict rules on what makes up a manufacturing building. So it's got some of the things there, like it's got to be involved in the transformation of a product. So very strict rules in terms of defining what manufacturing and production is. But it's a really nice deduction. If you're in this area, or if you are into manufacturing, if that's what your business is, it makes a lot of sense now to go and buy the building that you're in, because you could write off the full cost. And remember, you're probably getting a mortgage for that, so you're not out of pocket. Most of it's going to be funded by the bank, but you're getting a tax deduction straight away for the whole amount, which means your deposit basically is paid for by the tax savings.
Craig, is this what's driving all the gas stations and car washes?
I don't think that would
Or is that a North
qualify.
Carolina thing?
I'm not aware
I've
of
seen a
that.
lot of people go after setting up gas stations and car washes. And
Not that it's just a good business.
no, for the taxes.
Yeah.
And I'm like, I don't understand. But
I'm not aware of anything on that. I'll have to look into that.
So those
But
they
no,
would
it's
be
not.
manufacturing, wouldn't they?
well, that's the thing. He says here, food, beverage, crap.
They're excluded.
Oh, they're excluded.
Yeah. Food and beverage excluded. See, there's no transformation there. There's no. I mean, I know you've got a dirty car becomes a clean car. That's,
Yeah, you have gas pumps. I don't get it, but
yeah. No, I don't think that would qualify. Offices are out. You can't buy and lease these things and claim the deduction. So, but I mean, it's a really nice opportunity if you do have clients, or if you know people, or you are in the manufacturing world. Go and buy a piece of property. Bankers, you want to advocate this, because you're basically getting your deposit back from the tax savings. So other things to think about, of course, is cost segregation. I've got a couple of clients who've done that recently. Cost segregation is just, I think we've talked about it before, where you can, usually on a building like this, because it's called real property, you get to write it off over either 27.5 or 39 years, depending on commercial or residential. But you can get engineers who can come in here and they can analyze the building, and they can say, well, in this building, there's X $1,000 worth of movable stuff that we could rip out and take away, and wires and plumbing and conduit and all sorts of things. And they can do the studies, and they'll quantify that number satisfactorily to the IRS, and you can then write that off 100%. So if you paid $1 million for the building, but 300,000 of it was cost segged out as movable, you get a deduction for 300,000, and the 700,000 gets written off over 39 years. So it's quite a nice big tax deduction, and these guys will typically charge you a risk-based fee. But it's something to think about if you're going to buy a building and you don't quite meet the manufacturing rules, then look at doing a cost seg analysis. Oh, and there's a 10-year limit on this production thing. If it changes its nature within 10 years, there's a recapture of depreciation. In most cases, there's recapture wherever you're given depreciation as a deduction. That's bonus and all those things. When you sell the property or the asset or whatever it is, if you get anything back for it, then that's typically taxed at the normal rate. It's called recapture of depreciation. So, that's all I've got for you. Have you got any other questions?
so the specialty CPA firms are still doing cost segs then, but they don't need to do the R&D tax credits anymore, because that's now just going to get expense. Or is there still work to be done in that area?
There are still R&D tax credits, I think. Are there R&D tax credits, I think?
So they do still do the
You
study?
still get R&D tax credits, yeah.
Okay.
You still, a lot of those wage credits are still available. As far as I know, they're still plugging away doing their thing. I just caution against those, because we have a client who went out unbeknownst to us, went and got an R&D tax credit that paid them a fortune to get this credit and everything else, and then when it came to doing their tax returns, wondered why they didn't get a benefit, and it's because they were in a loss. You can't use the credit if you have a loss. So, it's all very well signing up these guys, and I mean, we can't do cost segs enough, because you need engineers, you need special rules, and typically we don't, if there's a credit to be claimed, we're going to do it, but we don't specialize in going after those things, because we want to look at the whole thing. We want to be holistic, and if there's a credit to be claimed and it makes sense together with everything else, then we'll do it. But, you know, a lot of these firms, that's all they focus on. That's their money, is getting you that tax credit. And they tend not to look at the bigger picture. That's just, yeah. Anything else?
I have another question about K1. If you get a K1, can you structure yourself as a business if it makes sense?
If you do what yourself?
W-2 employee, then several years into working as a W-2 employee, they now get a K1. Can that K1 be used like a 1099 to structure yourself as a business, or is that not a thing?
No. There is a thing with if the K1 is if the business is a partnership, and you get a K1 from a partnership, there is a section at the end there to claim unreimbursed partner expenses. You can do that with a partnership. And it's specifically part of the K1. It's allowed on Schedule E. It'll form a separate line on your Schedule E, page 2, where it'll say they're unreimbursed partner expenses, UPE. And so you can do that with a partnership, but you can't do it with an S Corp. I don't know why you can do it with the one and not the other, but yeah. Yeah, no, it's definitely, you can definitely do it with a partnership. Yeah. Anything else?
Opportunity zones, do you have to be considered a sophisticated investor, like a limited partnership, to invest in that? Because it's higher risk or?
That's a good question, because you're investing in the Opportunity Zone Fund, which is a separate company. So I would imagine it has to meet those, what's the Schedule D requirements? So, you know, if you raise money, you know, I think it's Schedule D, that so anyone raises money for a corporation, you might know this.
Reg D?
Reg D, I meant, yes. If you're raising money, then you can either raise money only with certain sophisticated investors that are worth, I think it's $1 million net asset value or 250,000 a year income or more. So there's a specific group of investors that you're allowed to offer the shares to in that company outside of Reg D. Otherwise, you've got to advertise, you've got to do a prospectus and all that kind of thing. And there's pretty severe consequences if you don't do that, as far as I know. That's more sort of legal, a little bit out of my bailiwick. Anything else? Well, thank you for your time.
Great job.